Hi everybody, I'm Steve McDonald and this is your Investors Daily Edge weekend wrap-up. In focus today, what brokers are buying for their own accounts, what's driving this market volatility, mid-cap's track record, the hidden good news in the May auto sales numbers, 4 months of improving employment numbers, and the weakening yen. Well, first up, having spent 10 years as a broker, I can tell you brokers are a unique group. You might want to call them unique animals, actually. What always amazed me about them was what they recommend to their clients as compared to what they're buying for themselves. It's rarely the same thing. I asked 3 of the best I know in the business to give me their best picks from the what they would own column, not what they're recommending to their clients. All 3 came up with energy-related plays. This is interesting. 2 of them sent me utilities with solid dividends, and 1 an energy producer, an actual oil producer. 1 suggested selling a call against one of the utilities they picked, but none recommended buying an option or anything that included any significant risk. This is consistent with what we've been seeing in the market for the last few months, risk aversion. Fearful investors, I guess the brokers fall into that category, have been rushing into short-term bond funds that basically pay nothing but have very little risk. Utilities have a hair more risk than this type of investment, but they have a much better return. Behind all the fear, in addition to the financial crisis we're carrying on our backs, is the volatility we've seen in the past few months. The price swings are enough to scare anybody. What's driving the volatility? The absence of the retail, or what we call the average investor. That's you. The swings we have seen lately in stocks are the result of the big boys, the institutions using computerized trading, taking very short-term profits when they can. They buy a lot quickly, they sell a lot quickly. The average investor tends to hold stocks longer and rides out the day-to-day volatility, which adds some stability to the equation. That's missing right now, and nobody knows when they, the average investor, are going to be back. This makes a very good case for our fractional buy and short-term profit technique we use in Sound Profits. Now, we have owned several positions, as many as 3 times in the past year, and have taken short-term profits on all of them. In fast, out fast, and average down your costs while you do it is basically what we're trying to do. Speaking of Sound Profits, the list of 7 stocks I sent you last week that you could add to in your portfolio or buy if you don't already know them, all but one of them are still in a buy range. So if you missed it last week, you can still buy or add to your positions, but only a 1/4 position. It's in the archives. Just look it up. Mid-caps, this is interesting. Did you know, going back as far as 1979, mid-caps have beaten both small caps and large caps? The trend now is toward mid-cap stocks with very little exposure to the EU. Look at hospitality, large retail, energy, and medical devices. All are showing interesting numbers. Auto sales. May auto sales were way up compared to a year ago. And that's not hard, really, when you consider that last year was a depression, but there is good news between the lines. Pickup truck sales shot up 50% last month, year over year. This is interpreted as a sign that small business is finally beginning to move out of the fear frozen mode to spending money. Why? Because most pickup sales, according to auto analysts, are made by small business people who use the trucks for their businesses. This is really good news. Next up, sort of good news on employment. We have had 4 months in a row of improving employment numbers. Not huge moves, but anything is a welcome relief when you're at 9.9% unemployed. The economic death spiral of 2008 and 2009 caused many industries to cut many more jobs than they needed to because nobody at that time seemed to have any idea about where the bottom would be, and certain industries are now having to really ramp up hiring. The result may be a stronger hiring trend than we are expecting in some sectors. The industries that are showing strong hiring now are alternative energy, biotech, and IT. The hospitality industry is also giving off signs of strength as well. Most of this activity so far has been on the West Coast, but we're seeing sprinklings of it everywhere. This is a good indication of where we should start seeing some stock activity in the next few quarters. Put these on your screen and watch them. And maybe, just maybe, the first sign of a partial decoupling of our markets from the huge focus they've had on the euro may be poking its head up, the weakening yen. The yen, according to currency traders, has shown a little weakness later, which may take some of the focus from the euro and give our market a break. I'm not a currency guy, but this would be a welcome news of any kind. Finally, this one's going to kill you today. This is the Slap in the Face Award. Thanks so much, by the way, for all the nice emails. I know you guys enjoy these, so do I. Anyway, today, Merrill Lynch, who's now owned, I believe, who did buy Merrill Lynch? Is it Citi or Bank of America? I can't remember. Anyway, Merrill Lynch gets the whack for paying a guy, this is crazy, $780,000 bonus. Now, the papers call this a loan, but in the brokerage business, that's how you're paid a bonus. It's a forgivable loan over 8 years, so every year they deduct 1/8 of it and just forgive it. It's a bonus. It wasn't a loan. Now, these bonuses, or loans if you prefer, are based on how much you made in your last job. I've done this, where you go from one brokerage firm to another. They interview you and say, how much did you make? You show them, some type of record, normally a W-2. And they pay you about that so that you can survive the transition. Well, this guy had never made more than $100,000 in his former job. He dummied up pay stubs and forged W-2s to fake his way in, and Merrill Lynch didn't bother to pick up the phone to confirm the information. This guy didn't show up for work. He only brought in 3 clients with a whopping $20,000 in assets, and he resigned by email. Now, this would be a major snafu if they had paid him nothing in a bonus. But to give a guy $780,000 and not do a background check, how come I can't find a job like this? Why do I always work for people who check my references? I just can't get a break like this guy, I'll tell you what. But he did do one thing right with the money. He bought this is awful. He bought a $280,000 Ferrari with the cash he was given. And this guy is managing other people's money. This is too much. You got to love these street hustlers, and they're all over Wall Street. That's about it. We'll see you Wednesday. For everybody here, I'm Steve McDonald. Thanks for being a part of us.